Welcome back to Realty Resource Radio. This is Lori Swearingen. I'm here with Greg Swearingen. We're on K107.1 FM. And we have with us the branch manager with AnnieMac Home Mortgage. I've actually done business with him, and he's a wonderful person. Welcome, Tom McLoughlin.
Hey guys, it's always great to see you, and I just thank you so much for the opportunity to be here and chat with you and whoever's listening.
Is it true you're a native of Central Ohio and a graduate from the Ohio State University?
That is a true story. One of the few people that are actually still from Columbus. Everybody I meet, or most of the people I meet, are from somewhere else.
Sure. That's funny.
So, hey, we're from here too.
And he's a graduate of the Ohio State University.
So we all know the real estate industry well.
Yes.
Yes, we do.
There we go.
There we go.
Well, we're talking about home mortgages. Reverse mortgages on the homes. And a lot of people don't understand reverse mortgages. And so could you just tell people what is a reverse mortgage?
Or what the heck'em is it?
Heck'em. Well, that heck'em term is one that most people don't hear, and if they do hear it, they say, "What the heck is it?" So,
is that why it got the name? No.
Probably. So, heck'em actually stands for Home Equity Conversion Mortgage. It is most commonly, or more commonly, known as a reverse mortgage, and that really is a program that's offered by the Department of Housing and Urban Development, and it's really administered by the Federal Housing Administration, FHA, right? So most people have heard about FHA.
Sure.
And really what it is a program that is designed to help seniors either stay in their homes longer if they already own their home, or to be able to purchase a home where they wouldn't have a mortgage payment for the rest of the time and potentially the rest of their lives, certainly as long as they live in that property.
Wow. That's pretty cool. I'm thinking of my own mother.
Exactly.
Yeah. Well, did you have a question?
Well, so what are some of the myths around it then? Because, am I just going to lose my house then? Say I can't make a payment. I mean, what happens? Or what are some of the myths that you are familiar with around this that you'd like to clear up?
Well, that's a good question. I mean, many people think that a reverse mortgage is one where the bank owns the house, or the government takes the house or owns the house. If you do a reverse mortgage, and really nothing can be further from the truth. It really is no different from an ownership standpoint than somebody who would do a regular mortgage, right? That would have a principal and interest payment. It really is just a way that rather than making a payment, you need more equity on the front side of it, and then the interest that would otherwise be part of a principal and interest payment is actually put to the back side of the loan, so that at the point where the house is sold, where somebody actually moves out of their house, or it is sold because they have passed away, the loan is paid off, and whatever it is that is remaining from an equity standpoint is then goes to the heirs or to the owners if they happen to still be alive.
Okay, that was my next question, so you just answered that. What happens to that?
Yeah, well, I think, and we were talking a little bit before the show about some good, clear examples for people, because who really benefits from a reverse mortgage? You gave me some great examples. I love the $200,000 example that you were talking about. Maybe we could go into that a little bit.
Sure. Well, let's take for an example. First off, one of the primary requirements to do a reverse mortgage is that you have to be 62 years of age. So all of the borrowers for a reverse mortgage, they have to be at least 62 years old. Okay. And if they are 62, let's take somebody who owns a home that is valued at $200,000 and they either own it outright or they don't owe very much money on it.
Sure.
But they don't have very much income, right? They've lived in it for 25 or 30 years, and they still want to live independently.
Sure. So they're in their house that they've been at for maybe 20, 30 years.
Right.
And it's basically paid off. It's a $200,000 house, and they just don't have much income.
Exactly. And they might want to not have as big of a home, or they might not want to be able might not want to have to take care of the upkeep that it takes with an older home. They want to downsize to, say, a condominium, or they want to downsize to a smaller home. Those folks could sell that house for, call it $200,000, and they could go buy another house, a $200,000 house, but they would only need roughly 50% of that money to do that. So
Sure.
$100,000, they would keep $100,000. Now these are rough numbers. You need less money the older that you are, because it's all actuarial based, and it's based upon people living to be 100 years old. So somebody could purchase a $200,000 house, call it for a $100,000 loan-ish, and never make another mortgage payment. So
what happens if it's in a trust?
And then they'd have $100,000 cash sitting around too. They would have to use.
Exactly. They'd have $100,000 cash. More importantly, though, if you think of people that have, when they're getting older and they're not working any longer, they have a fixed income. So to purchase a new home that would have a mortgage that required a payment, principal and interest payment, along with the taxes and the insurance, every month, might be difficult for them to qualify for, from an income standpoint, or maybe from a credit score standpoint. So those people really would have the ability to purchase a home for roughly half of the cost of the house, never have a mortgage payment, and their quality of life is greatly improved, in my view anyway, because they would have the income that they would normally have per month, and the only expense from a housing standpoint, besides the utilities, would be to pay for the real estate taxes, the homeowner's insurance, and if they happen to have a homeowners association, they have to pay that as well.
So what, I had a question about trust account. Like my mother's in this situation where she owns her home outright and it's in a trust account, and I mean, how could she do this kind of a loan, or what is the? It
would probably have to come out of the trust first and close in her name,
okay,
and then it could be put back in the trust.
Okay.
And it may be able to be done inside of the trust if she is the only owner of it, but either way, there would be a way to address that.
Okay,
where
that's
again,
good to know.
she would never have, she would then have at least some of the money in cash to be able to do other things with if she wanted to travel or whatever.
Right.
Pay medical bills.
Because I mean, her house is getting to the point where it's causing her a lot of work, and she's worried about leaving it to us kids as an investment. So I'm just speaking from a personal perspective for all those listeners out there that might feel the same, or maybe they have a parent in that situation.
Exactly. She would be a perfect candidate, and
I would think so.
And from people that would be interested in this would be not only those over 62, but like you're an adult child, as am I. So to be able to,
I'm not far from there though.
I'm not either. So to be able to look at your parent situation and say, you know what, this might be an option for you if you want to stay in your own home. I mean, many people that are getting older, let's face it, some people want to be in a facility, a retirement community, but there are many others, particularly in the younger side of retirement. They are independent. They want to continue to live independently.
Yeah, she definitely does not want to, wants to support herself as long as she can.
So she would have the ability to, and she might not income qualify, right? If she doesn't have any income, if she were going to go buy a house and income qualify, she might not on her income.
Right. So this helps with that. That's awesome.
So it could be difficult approving somebody for a new home mortgage if they only get like Social Security.
Well, with
this loan though, correct?
Right. There aren't any income qualifications for this, and there aren't any credit score qualifications. The new qualified mortgage rules that went into effect early in January of this year say that the maximum ratio for somebody with all of their expenses that report to the credit bureaus would be 43%. Now there can be some exceptions that would get it a little bit higher than that, some compensating factors, but generally speaking, 43%. Somebody on a fixed income, that's not a whole lot. So this is a way really for them to improve the quality of their life. Still own a property, still live independently, never have a mortgage payment, and guess what? The government doesn't take it, the bank doesn't take it.
That's
the
great.
house gets sold. One point I wanted to make about that: if somebody were to live to be 105, and the amount of the loan had grown to a place
you can only hope, right, that they live to be 105.
Yeah, the amount of the loan has grown beyond what it is that the house would bring at its sale. The children or the estate would not be responsible for any shortfall. This is an FHA insured, government insured mortgage.
What is FHA again, just in case somebody doesn't know?
Well, Federal Housing Administration, right? And you hear about first-time home buyers use FHA programs all the time, right? You do that all the time. We do it together all the time. So It is the same program except in reverse for individuals that are over 62.
Very cool. It's like, you supposedly regress when you get older. Well, now you get to regress on your payment, right?
Well, to not have a mortgage payment. Here's an example if you want to hear one. I have a client currently that I'm doing a purchase loan for, a HECM purchase, reverse mortgage purchase, who currently lives in an apartment, has lived in an apartment for many years because they can't afford a house. Right? They haven't been able to afford the payment for a house.
Sure.
They just got a $50,000 inheritance from a relative that passed away.
Wow.
So how much house can you buy for $50,000? Not a whole lot.
Not much at all.
Right. Okay. But what they did was they took that $50,000.
That's a
They
down
bought a
payment?
$100,000 house. They'll never have another mortgage payment, and what they were paying in rent is now able to cover the real estate taxes and the insurance, and then some. And so they now can be homeowners, live in their own
Nice.
home,
Very cool.
and never have a
And what
payment.
they were paying for rent is now available to them to use however they need it.
Exactly. Whatever income they have beyond that is theirs to use however it is that they need. Older people, they might have more medical expenses. They might
Sure.
want to travel. They've got grandchildren that they want to buy presents for. All of those things are available when somebody does a reverse mortgage and eliminates that from the equation.
Nice.
Yeah.
Nice.
Well, I'm glad you were able to explain that, because I've been so confused about reverse mortgages for the longest time.
Yeah.
But to realize that even like on a purchase, I didn't know you could do a purchase until I was talking to you. I mean, I knew you could do the home equity
Right.
part of it, but I didn't
Right,
know
refinance.
the purchase part was new.
Yeah.
And so the fact that you could take $95,000 and put it down on a $200,000 property and then just not have rent payments, the mortgage payments, and just live there, basically